Hello everyone, welcome to the 86th episode of me learning how to trade in Forex. So in the last video we finished off everything in the fundamental analysis section with market expectations of news and their impact on currencies. We went through the consensus market expectations, which is what few experts generally think of what the market might happen in the future. With three criteria, so as expected, better than expected, worse than expected. What's priced in? So Forex traders have already priced in consensus expectations in their trading and entered the market well before the report scheduled so released. Market sentiment can improve or get worse just before a release, so price can react with or against the trends. Expectations and reality, so coming up with different scenarios and prepared to react to the market's reaction. Data revision, so be sure to be aware of data being revised. And and we've done the quiz, and now we are on to what is a currency crosspair. So what is a currency crosspair? 26th. Let's get going. Back in the ancient days, if someone wanted to change currencies, they would first have to convert their currencies into US dollars, and only then could they convert their dollars into the currency they desired. The US dollar was known as a vehicle currency since the currency was used as a medium of exchange for international transactions. For example, if a person wanted to change their UK sterling into Japanese yen, they would first have to convert their sterling to US dollars and then convert these dollars into yen. With the invention of currency crosses, individuals can now bypass the process of converting their currencies into US dollars and simply convert it directly into their desired currency. Some examples of crosses include GBP JPY, EUR JPY, EUR CHF, and EUR GBP. Calculating currency cross rates. Warning, this part is a little boring. Unless you like numbers, it's not difficult, but it can be kind of dry. The good news is that this section really isn't necessary anymore since most broker platforms already calculate cross rates for you. Right, okay. However, if you're the type that likes to know how everything works, then this section is for you. And besides, it's always good to know how things work, right? In this section, we'll show you how to calculate the bid, the buying price, and ask the sell price of a currency cross. Let's say we want to find the bid-ask price for GBP/JPY. The first thing we would do is look at the bid-ask price for both GBP USD and USD JPY. Why these two pairs? Because both of them have the US dollar as their common denominator. Right, okay. So, to calculate the bid and ask price for a currency cross, which is any currency pair which doesn't have USD in it, look at the bid ask price in relation to USD, i.e. to calculate the bid's ask price for GBP/JPY, look at the bid ask price for both GBP/USD and USD/JPY. Why these two pairs? Because both of them have the US dollar as their common denominator. Yep. These two pairs are called the legs of GBP JPY because they are the US dollars pairs associated with it. Now let's say we find the following bid-ask prices. So GBP USD is 1.530 for bids and 1.5635 for ask. USD JPY is 89.38 bids and 89.43 ask. To calculate the bid price for GBP JPY, you simply multiply the bid prices for GBP USD and USD JPY. If you've got 139.70, good job, your calculator is working properly, yippee. You simply multiply the bid, so multiply these two together. To get the ask price for GBP/JPY, just multiply the ask prices, so these two, for GBP USD and USD JPY, and we get 139.82. Easy as pie. Then to calculate GBP/JPY, multiply the bid price, multiply the bid prices for GBP/USD and USD/JPY. To calculate GBP/JPY sell price or ask price, multiply the ask prices for GBP/USD and USD/JPY. Easy as pie. Why trade currency crosses? (26.03) Over 80% of the transactions in the Forex market involve the US dollar. This is because the US dollar is a reserve currency in the world. You may be asking yourself why the US dollar and not the sterling or euro. Most agriculture and commodities such as oil are priced in US dollars. Most agriculture and commodities such as oil are priced in US dollars. If a country needs to purchase oil or other agricultural goods, it first has to change its currency into US dollars before being able to buy the goods. This is why many countries keep a reserve of US dollars on hand. They can make purchases much faster with greenbacks ready in their pockets. Countries such as China, Japan, Australia are examples of heavy importers of oil, and as a result they keep huge reserves of US dollars in their central banks. In fact, China's has over 3 trillion US dollars in its reserve stockpile. Japan and Switzerland hold over 1 trillion each. So what does this all have to do with trading currency crosses? Well, since most of the world is glued to the US dollar, a majority of trading speculation will be based on one question: is the US dollar weak or strong today? This one question will affect many of the most liquid currency pairs, the majors: GBP USD, Euro USD, USD CHF, USD JPY, the commodity pairs AUD USD, USD CAD, and NZD USD. Notice that all these pairs are tied to the US dollar. This doesn't give the trader many options when most of their trading decisions are based on this one speculation. USD versus major currencies. In 2009, the dollar was negative across the board. Notice how the dollar move was universal in almost every major currency pair. You can see that by trading any of the 7 most popular currencies, you're basically taking either an anti-US dollar or pro-US dollar stance. This one speculation affects these pairs in almost the same way across the board. Conversely, in the stock market, traders have multiple companies to choose from and are not bound to one major speculation idea. DJIA companies in 2009, although the DJIA was up over 1,400 points in 2009, 9 of the 30 companies that make up the index were still negative. With stocks, you can see that even though the overall market was positive, there are still plenty of other trading opportunities. There isn't just one kind of speculation that affects the entire basket of stocks. Currency crosses provide more trading opportunities. Instead of just looking at the 7 major dollar-based pairs, currency crosses provide more currency pairs for you to find profitable opportunities. By trading currency crosses, you give yourself more options for trading opportunities because these currencies are not bound to the US dollar, thus possible having different price movement behaviors. So whilst the majority of the markets will only trade on anti-US dollar or pro-US dollar sentiments, you can find new opportunities in currency crosses. Well, I haven't even written anything down yet. Many countries keep a reserve of USD on hand. Trading currency crosses, a majority of trading speculation will be based on whether the USD is weak or strong today. The majors, the commodity pairs, so GBP/USD, EUR/USD, USD/CHF, USD/JPY, commodities, AUD/USD, USD/CAD, NZD/USD. Notice all these pairs are tied to the US dollar. You're basically taking an anti-US dollar or pro-US dollar stance. Because they're not currencies, they're not bound to the US dollar, thus possibly having different price movement patterns. So whilst the majority of the markets only trade on anti-US dollar or pro-US dollar sentiments, you can find new opportunities in currency crosses. For example, all of the dollar-based pairs might be trading sideways or in some uglier fashion where it would be smart to just sit on the sidelines or wait for better trade setups. But if you knew to switch your charts to look at currency crosses, you might just find trading opportunities galore. Be different, the majority of traders just trade the majors. Now you can be part of the minority that trade currency crosses. Don't ignore currency crosses when trading. Currency crosses are trendy. Trendy. 26th. Since the majority of the Forex market would deal with the US dollar, you can imagine that many of the news reports will cause US dollar based currencies pairs to spike. The US has the largest economy in the world, and as a result, speculators react strongly to US news reports even if it doesn't cause a huge fundamental shift in the long run. What this means for your charts is that you will see several spikes even if there is a trend emerging. This can make it hard to spot trends or range conditions. From February to April 2019, the Euro USD ranged its way up to 1.3700. As you can see, it wasn't a smooth ride up there. So it went down and then it went up first. It went down first and then went up. The day-to-day economic activities of the US can keep US dollar-based currencies such as Euro USD above from making smooth trends. So day-to-day economic activities of the US can keep USD-based currencies from making smooth trends. From February to April 2009, the Euro JPY also rose, but unlike the Euro USD, it made a smooth ride to the top. Conversely, you can see that during the same data range, cross-currency Euro JPY made a much smoother ride to the top. This was probably due to fewer spikes that came from US data. So as you can see, both charts show the Euro rose during the same time period, but the one without the US dollar made for much easier trades. Here's a trade example where 100 pips was bagged riding Euro JPY's trends. Check out how we caught that move. If you're a trend following kinda dude, then currency crosses may be easier to trade than major pairs. It will be easier for you to spot the trend and be more confident in your entry points because you know that these technical levels hold more than they do for the majors. Could be easier to trade than the major pairs when trading trends. In the next section, we'll discuss how playing with currency crosses can also allow you to take advantage of the interest rate differentials. Now that's like a cherry on top of a sundae. Trade interest rate differentials. Interest rate differentials being the difference between one interest rate to another, right? By selling currencies whose country has a lower interest rate against currencies whose country has a high interest rate, you can profit from the interest rate differential known as a carry trade as well as price appreciation. By whose country has a lower interest rate against currencies whose country has a higher interest rate, you can profit from the interest rate differential as well as price appreciation. That's like being able to get a frosted cup with sprinkles on top. That talks to you. Imagine how delicious that would taste. Currency crosses offer many pairs with high interest rate differentials that are prime for these type of trades. For example, take a look at a nice uptrend on AUD JPY. If you had a long position on this pair, you would have made a hefty profit. What is this? On top of that, the interest rate differential between AUD and JPY was huge. From 2002 to 2007, the Reserve Bank of Australia has raised interest rates to 6.25%, whilst the Bank of Japan kept the interest rates at 0%. That means you made profits off your long position and the interest rate differential on that trade. Now that'd be an awesome cash cow right there. Later on in college, if your brain hasn't exploded with all this Forex knowledge by then, we'll teach you more about carry trades. We'll teach you which ones will work and which ones won't. We'll even teach you about a little something called risk aversion, but that's for a later lesson. Be careful trading obscure currency crosses. Obscure currency crosses. Whilst the euro and the yen crosses are the most liquid crosses, more currency crosses exist that don't even include the US dollar, euro or the yen. We'll call these the obscure currency crosses. If we were in school, come to think of it, we actually are in school, the major pairs would be the jocks, whilst the obscure currency prices would be the eccentric emo kids or hipsters. That's because most Forex traders would rather hang out with the cool crowd than the obscure crosses. We're talking about really weird combinations like AUD CHF, AUD NZD, CAD CHF, and GBP/CHF. That's why we call them obscure crosses. Trading in these pairs can be more difficult and riskier than trading euro or yen currency crosses. Since very few Forex traders trade them, transaction volume is much lower, resulting in lower liquidity. Due to the illiquid markets for these crosses, the prices can become quite volatile, so being stepped out on whipsaws can become a common occurrence. Check out these screenshots of AUD CHF and GBP CHF. So what's this? AUD CHF, 60 minutes. Check out these spikes. So these outliers. You don't want to get stopped out by these nasty spikes, do you? That's why most Forex traders usually put wider stops when trading these pairs. But judging from the choppy movement of obscure crosses, it would really be tough to catch a good trade on these pairs. Choppy zone. Because there's no clear trend going on basically. See what we mean? Also, since these currency cross pairs aren't traded too much by Forex traders, the spreads on these pairs can be pretty wide. If you want to trade these currency crosses, just be ready for some wild price swings and be willing to pay the price of the massive spread. Euro and yen are the most liquid crosses. Obscure crosses are more difficult and riskier to trade. Transaction volumes is much lower, resulting in lower liquidity. Meaning their prices can become quite volatile. Let's get a picture of this as well. What am I doing? There we go. Okay. Whoops. How to trade fundamentals of currency crosses. With currency crosses. If strong economic data comes out of Australia, you might want to look at buying AUD. Your first reaction might be to buy AUD USD. But what if at the same time recent data also show the United States experience strong economic growth? The price action of USD AUD may be or AUD USD may be flat. One option that you have is to match AUD against the currency of an economy that isn't doing so well. What could you do? Thank the Forex gods for currency crosses. Let's say you did some analysis, checked the babypips.com economic calendar, shameless plug, and you notice that the Japanese economy isn't doing so good right now. What do? Of course, like any self-respecting bully, you jump all over this opportunity to go long AUD JPY. In the chart above, notice the relative strength of AUD JPY versus AUD USD. So it's not much movement for AUD USD, whereas there's a huge spike for AUD JPY. You're not limited to just these currency pairs. You could have compared AUD against like Euro, GBP and CAD. From there, you can look for the weakest currency to trade against. There's nothing wrong with being a bully, at least not here at the School of Pipsology. So, if strong economic data comes out of one country, was it? You can look to a buy opportunity could be present. Therefore, match the currency. Therefore, match the currency with a currency that isn't doing well. Like that. You can look for the weakest currency to trade against. Yep. If it's your job as a forex trader to take advantage of certain opportunities so that you can put some silver dollars into your piggy bank. Because of currency crosses, you now have the opportunity to match the currency of the best performing economy against that of the weakest economy without having to deal with the US dollar. Right. So match the currency of the best performing economy against that of the weakest economy, but don't try to do it with a I guess obscure pair that we just learned in the last lesson, because then surely it won't be that liquid to trade. So it's going to be more difficult to get the price action you want, maybe. Yeah, so just stick with the normal one. So like what do they say, compare it against the AUD, was it Euro, GBP and CAD, like these. Yeah. How to trade a synthetic currency pair and why you probably shouldn't. How to trade a synthetic currency pair and why you probably shouldn't. Sometimes institutional forex traders can't trade certain currency crosses because they trade in such large sizes that there isn't enough liquidity to execute their order. In order to execute their desired trade, they have to create a synthetic pair. How to create a synthetic currency pair. Let's say that an institutional forex trader wants to buy GBP/JPY but can't because there isn't enough liquidity. To execute this trade, they would have to buy both GBP USD and USD JPY. Earlier in this lesson we learned that these pairs are called its legs. They are able to do this because there is plenty of liquidity in GBP/USD and USD JPY, which means they can make large orders. If you're a retail forex trader and you want to pretend to trade like an institutional trader, then you could technically trade synthetic currency pairs as well, but it wouldn't be too smart. Ever since the great Al Gore invented the internet, technology has improved to the point now that even weird currency crosses like GBP/NZD or CHF/JPY can now be traded on your forex broker's platform. Aside from having access to a larger menu of currency pairs to trade, the spreads would be tighter on the crosses compared to the synthetic pairs you would create. And let's not forget about margin use. Creating a synthetic currency pair requires you to open two separate positions, and each position requires its own margin. This locks up unnecessary capital in your trading account when you could simply trade the cross currency and save on margin. So unless you're trading yards, forex slang term for 1 billion units, forget synthetic currency pairs and stick to currency crosses. You'll be saving yourself some pips thanks to a tighter spread, as well as freeing up your capital so you can take on more trades. No, wait. So, was it synthetic currency pair? Institutional forex traders create a synthetic pair, trade certain currency crosses because they trade in such large sizes that there isn't enough liquidity to execute their order. But as a retail Forex trader, don't do this due to wider spreads. And locking up unnecessary capital. Wider spreads and locking up unnecessary capital. Yep. Trading the euro and yen crosses. After the US dollar, the euro and yen are the most traded currencies. Yen are the most. And like the US dollar, the euro and yen are also held as reserve currencies by different countries. So this makes the euro and yen crosses the most liquid outside of the US dollar based majors. Trading the euro crosses. The most popular euro crosses are EUR, JPY, EUR, GBP and EUR CHF. Crosses EUR, JPY, EUR, GBP, EUR, CHF. News that affects the euro or Swiss franc will be more felt in euro crosses than euro USD or USD CHF. UK news will greatly affect euro GBP. So news that affects the euro or franc will be felt more in euro crosses than EUR USD or USD CHF. UK news will greatly affect EUR GBP. Oddly enough, US news plays a part in the movement of euro crosses. US news makes strong moves in GBP USD and USD CHF. US news makes strong moves in GBP slash USD and USD slash CHF slash CHF. Well, yeah, because they've all got euros, USDs in them, so US news is obviously going to make a difference to these currency. They're not crosses to these major pairs, I guess. US news plays a part in movement euro. This not only affects the price of GBP and CHF against the USD, but it could also affect the GBP and CHF against the euro. It's not only affects the price of the GBP and CHF against Euro, against the USD, but also affects the GBP and CHF against the EUR. A big move higher in the USD will tend to see a higher Euro CHF and Euro GBP, and the same goes for the opposite direction. Big move higher in the USD will tend to see higher EUR slash CHF and EUR slash GBP, and the same goes for the opposite direction. Confused? Okay, let's break this down. Let's say that the US shows positive economic data causing the USD to rise. This means that GBP USD would fall, driving the price of GBP down. At the same time, the USD CHF would rise, also driving the price of CHF down. The drop in GBP price would then cause Euro GBP to rise, since traders are selling off their GBP. The drop in CHF price would also cause Euro CHF to rise, since traders are selling off their CHF. Conversely, this would also work in the opposite direction of if the US showed negative economic data. Wait, if the US showed strong economic data, so the USD is stronger than GBP, so that value would go down. Yep. USD CHF would rise, so this one's becoming stronger than that one, so that would increase as well. But why would that drive? Oh, that would drive the CHF down. Right, okay, yep. Drop in GBP price would then cause the Euro's GBP to rise. Yep, since the traders selling off their GBP. Drop in CHF price would also cause Euro CHF to rise, since traders are selling off their CHF. Yep. So both of them would cause the Euro to rise here. Trading the yen crosses. The JPY is one of the more popular cross currencies, and it is basically traded against all the other major currencies. Euro JPY has the highest volume of JPY crosses according to the latest triennial central bank survey from the Bank for International Settlements. GBP/JPY, AUD/JPY, and NZD/JPY are attractive carry trade currencies because they will offer the highest interest rate differentials against the JPY. Right. EUR/JPY as the highest volume of JPY crosses GBP/JPY, AUD/JPY, and NZD/JPY. Offer the highest interest rate differentials against the JPY. When trading JPY currency cross pairs, you should always keep an eye out for the USD JPY. Watch for USD JPY when trading JPY currency crosses. When key levels are broken or resisted on this pair, it tends to spill over into the JPY cross pairs. When key levels are broken or resisted, it tends to spill over into the JPY cross pairs. I just thought it would be, you know what, in the future it'd be good to get like loads of different charts for one currency when you look at just one currency. So get all the charts available that correspond to that currency. So whether it's, so say if you're looking at euro, get all the currency charts, not the currency charts, the plots basically, the price action plots with which contains euro in it. So euro against, I don't know, USD, GBP, everything against euro, and then just like lay them on top of each other and see how, I guess, one movement could affect the movement of another, or see if there's any similarities and differences, and like see if how one movement in one currency pair would affect the movement in another currency pair or something like that. So yeah, that'd be good. When key levels are broken, yeah, for example, if USD JPY breaks out above key resistance area, it means that traders are selling off their JPY. This could prompt the selling of the JPY against other currencies, but therefore you could expect to see Euro JPY, GBP JPY, and other JPY crosses rise as well. The CAD JPY. Over recent years, this currency cross has become very popular, becoming highly correlated with the price of oil. Canada is the second largest owner of oil reserves and has benefited from the rise of oil prices. On the other hand, Japan is heavily reliant on importing oil. In fact, over 99% of Japan's crude oil is imported, as it has almost no native oil reserves. These two factors have caused an 87% positive correlation between the price of oil and CAD JPY. So, CAD JPY has an 87% positive correlation. Well, that 87% is a bit iffy, between the price of oil with the price of oil. Correlations: oil versus CAD/JPY. Oil is the blue line, CAD/JPY is the red line. Yeah, I don't get how they calculated 87% positive correlation. Oh, so are they saying when one's positive, then the other one has 87% chance of being positive as well? And vice versa, when it's negative, it'll go negative as well. I think that's probably what they're trying to say, except that bit there, but 87%, hey ho. Let's stick that picture in there as well. Like that. Cool. I am going to leave this episode here. In the next video, we're going to go through how to use currency crosses to trade the majors. So, well, we actually went through a lot of lessons today, but they're all short. So, but yeah, thank you all for watching this video, and I will see you on. Goodbye.